Good morning.
Okay, very good
Good
morning.
morning.
Good morning. Okay. So today, in fact, Mr. Lalit Fernand was supposed to take the next module from today, that is basically credit risk part, but unfortunately, he can't take it today. So am going to start from market risk measurement and management. So basically, then this will continue for about 3 to 4 weeks. So I will take you through this module for about 3 to 4 weeks from today onwards. And so it's important. Of course, there is no relationship between this and the credit risk, so there is no problem which is being done first. Basically, last week, what we discussed was about the basic introduction to risk management. What is risk? What is uncertainty? The different components of risk, and what is enterprise-wide risk management framework? What are the components of it? And how do you set up a framework? And who is responsible? So in the context of setting a framework, risk prioritization, which is very important, building a risk matrix, identify most critical risks which need risk mitigation or risk controls, and what are the different types of risk mitigation we have in place in a business institution. Then risk attitude, how different entities look at risk or different individuals look at risk from a bank or financial institution perspective. How do you consider different risks among different banks? So again, risk attitude, risk averse, risk seekers, risk neutral, and so on. Then we looked at integrated risk management framework, specifically focusing on a bank. So who is responsible for the IRM framework, and then what are the procedures and policies and procedures that should be in place. And then we discuss about different components for policy framework with respect to credit market, liquidity, operational risk. Also, we looked at stress testing, how we look at the impact on your financials and the overall condition of the bank, if there are probable future events, and then what measures we can take right now. So basically, those are the things we covered on the introduction part during last couple of days. Okay. So before today we start with one of the key elements of risk faced by a bank or financial institution, basically market risk. So there are different risks exposed to by a bank or financial institutions: credit, operational, market, liquidity, and strategic, reputational, legal, so many risks. But among them, most importantly, market risk is, widely exposed risk among many bankers, because this is related to 4 different components. And one of the key components is interest rate. So probably we will touch on that today. So before we start, are there any questions to clarify before we further proceed with the new area? Okay, so that's good. So this is little, we start with the, more practical sessions from today onwards. Practical in the sense what is really, applying to your day-to-day environment. Okay. So before we start, let's give an introduction about market risk. So what is market risk? The potential risk that value or earnings of a financial institutions institution may decline due to exposure to systematic risk factors. So potential risk, the possible risk, that value, so the value of the financial institution, the market value of the financial institutions, or earnings means income of financial institutions may decline due to exposure to systematic risk factors. Remember last week I mentioned about systematic risk. Remember last week when we talked about risk in banks and financial institution, we discussed about another important risk. What is that important risk? A broad risk, which is very important.
Systemic risk.
Systemic risk, yeah. So we discuss about systemic risk. That is the risk of problems in or collapse in one institution, spreading to the other institution, and then finally to the entire system. We call contagion effect of a failure of one financial institution spreading to the entire system. But remember, I said that systemic risk is different to systematic risk. Now, systematic risk is something coming from market-related factors. So, what are the market-related factors? Interest rate, foreign exchange rate, the equity prices, the commodity prices. So, there are four typical components of market risk, which we discuss separately during the different modules. So today we will focus on interest rate risk. But if you look at why we call these factors market risk factors or the systematic risk factors, why we call them market systematic risk factors? Anyone? Because if you look at these four elements of risk, basically factors, a bank does not have any control over them because you can't control them. Okay, these are coming from the market. Okay, so you don't have any control. Now, interest rate. Now, when you talk about interest rate, increase or decrease in interest rate, you don't have any control. Because whenever the market interest rate goes ups and downs, what happens? It will affect your portfolio value or income. You don't have any control. So what you have to do is, by looking at potential interest rate that could arise, interest rate risk that could arise, you have to have your own risk management techniques in place to manage it, because you don't have any control. So whenever market, because interest rate is, again, if you look at like any other price, because interest rate is the price of money. We will look at a little later. So the price of money, like, does anybody have unless like somebody comes and tell, you have to fix the interest rate at this particular level, like some governments sometimes say price is fixed at this rate. So it's a controlled economy, okay? But in a market economy, you don't have any control. Now, price will go up and down depending on the demand and supply or many other factors, okay? So basically, you don't have any control. None of us have control on the price of, rice in a market, okay? So you see the price 6 months ago is totally different to 6 months later or 1 year ago. It may go up, it may come down. So it is determined by the several market factors. So interest rate also determined by several market factors, so that it could go up or down where a bank does not have any control. Okay. So due to this fluctuation, you may end up with a negative situation depending on your portfolio position. So the two impacts you have is, one is on your value, one is on your earnings. Then foreign exchange risk. Now, what is foreign exchange risk? The risk arising from changes in the exchange rate. So due to the exchange rate changes, the market value of your foreign exchange portfolio will be affected, resulting in, I mean, if it's a gain, that's fine, but our risk is the resulting in a loss and ultimately income. But does anyone have a control on foreign exchange risk? No, we don't have any control. It's a market determined price for the local currency against a foreign currency. So we don't have any control. Then equities risk. Again, prices of the market of equities. So if you have a portfolio of equity investments in your bank, then whenever the market prices of those equities goes ups and down, your equity portfolio value will change. If it is a negative impact, that is value goes down, and you have to take a hit when you want to maintain in the books value or when you want to trade in the market. So again, you don't have control. We don't have any control now. Tomorrow, what is going to be, let's say, a typical stock like John Cale's Holdings. If you have a portfolio of equities in John Cale's Holdings, so we don't know the price tomorrow. Does any one of you bank can control it? No, you don't have any control. Can, let's say you invest in equity of John Cale's, let's say at 105 rupees. So can you control the market so that it will not come below 105? No, you don't have any control, because that again is determined by the market, several market factors, demand and supply, many other factors, which could result in a negative or the decline in price, which ultimately impact your portfolio position. Okay, so again, the equity price is a market variable which you don't have any control. So then finally commodities risk, but of course in Sri Lankan banks, we don't see much commodities in the balance sheets. Okay, but in some international banks, the commodities are also, because they are in the business of trading commodities as well. Some banks, so there's a commodity market in countries like US and Europe where gold, copper, nickel, there are many other commodities. So the banks do engage in trading. But of course, maybe Sri Lankan banks, sometimes you may have gold as a commodity, but rather doubtful to engage in trading. But of course, if you have stock of gold portfolio or any commodity in your balance sheet, again, price fluctuations in the market could lead to a decline in your value if the price declines. So basically, where you don't know, can any one of you have a control? Where it takes very pretty simple about gold. Does any one of you have control on the gold price? If you have a portfolio in gold, no. The gold price determined by the market supply and demand and many other market related factors where you don't have a control. So basically, if you look at all these factors are related to market-driven factors where you don't have control, but as a banker, you may have a significant exposure to these, 4 areas. Specifically, so especially the first two, interest rate and the foreign exchange rate, where a possible threat could arise, leading to decline in value or earnings of your financial institution. So basically, we will focus on the first 3 areas because we don't have much exposure in our banks in commodities. But we will focus on interest rate risk, foreign exchange risk, and the equities risk. So I will basically go through first one and the third one, and foreign exchange risk will be done by another resource person. So if you have any questions, please interrupt me at any point. I can't see you all. So let's start with, okay, now again, market risk defined as the risk of losses in on and off balance sheet. Now, one of the important element is now risk does not arise from only the on-balance sheet, but also from the off-balance sheet positions. I think all of you know what is off-balance sheet. Anybody, what is off-balance sheet? Anyone, off-balance sheet?
Factors that are not appearing in the balance sheet financially.
Yes, but I mean, can you give a brief example why they call off-balance sheet?
Because you can't measure them on financial terms.
Not really. I mean, you can measure them. You can measure them, but anything else?
I think you don't have any control over them.
Sorry?
We don't have any control over them.
No, you have a control. So then again, if you look at on-balance sheet also, you don't have control. Okay. So that is not the main.
Excuse me.
Anyone else?
In terms of the what you call the particular day, as of any particular day, that the commitment or the asset has not clearly arise, but there is a contingency of happening or receiving such instruments. Suppose guarantee. We have given a guarantee, but as of now that has not occurred. But in future there would be a commitment for the guarantee.
Okay. So yeah, you are partial. Yeah, you are right. But now, if you look at on-balance sheet at the time of contract you entered between the parties, there is a typical movement of funds from the bank. Okay. So and there is a risk directly arise at the time of entering into the contract. Now, when you grant a loan, it's a probable risk, and there's a contract immediately arising, affecting your balance sheet position. But if you look at off-balance sheet, there is no immediate financial threat to you. Okay. Now, what the previous spokesman said about a guarantee. Yes, when you give a guarantee, there is no immediate fund involvement or risk to the bank. It's a simply bank give a guarantee where the person who obtained the guarantee defaults, bank is taking that liability. So there is no immediate fund involvement, but there's a possible future risk that if the person who obtained the guarantee from the bank defaults, that liability fall on the bank. So at that time, it will become a liability of the bank. So it will come to the on-balance sheet. So basically, off-balance sheet is the contingent events. Okay, contingent events. There is a possibility of future risk arise, but not at the moment on the balance sheet, because balance sheet is based on real assets and real liabilities, what you own and what you have to pay to the other parties. So basically, so many off-balance sheet items in a bank. I think if you look at off-balance sheet items in a bank compared to any other institution, very significant. Guarantees, letter of credits, then performance bond, bid bonds, forward contracts. There are many derivative products, even loan commitments, partial commitments, and many more items in a off-balance sheet event. Okay. So basically, when we talk about market risk, so it's about both on and off balance sheet. You have to consider. Now, for example, guarantee. Okay, LC. Okay. So basically, when we talk about market risk, there are some definitions. Even from the Basel point of view, what is market risk? related to these four components. So when you talk about interest rate and the equities, risk pertaining to the trading book. Okay, risk pertaining to interest rate related instruments and equities in the trading book. Remember? Then if you look at take foreign exchange and commodities, it is throughout the bank. So that means trading book plus banking book. But interest rate and equities, it's only in the trading book. Because if you now, what is trading book and what is banking book? So what is the difference? So what do you mean by trading book? What do you mean by banking book? Anyone? Trading book and banking book.
Trading book represents the instruments that bank use for purpose of trading. So
Yes.
banking book represents the all the financial assets and liabilities that banks having at any particular given time.
Yeah, but then if you look at all assets and liabilities, trading book assets are also in the balance sheet.
Trading book used for purpose of trading.
Okay, but where does it represent? Is it separate from the balance sheet?
No. It's inclusive of the balance sheet.
Okay, but you said in the what you call banking book, it includes both assets and liabilities.
Yeah. Isn't it, sir?
So then trading book also part of banking book. Okay, so
Banking book.
yeah,
I think so.
not that is liquid in liquidity perspective, but really what do you call in a bank balance sheet, you can separate the instrument you hold in the bank for two purposes. One is holding purposes, where you hold it till maturity, mostly till maturity, and one set of assets for buying and selling purpose, for the trading purpose. Okay, so same instrument can represent in the trading book as well as a banking book. Depends on your objective. So the classification depends on objective of the bank. So for my question, which I just said, can one particular instrument can be in the trading book and also can be in the banking book or not? Can a particular trading asset in your bank hold both in the trading book and the banking, instrument, particular instrument?
Yes.
You take a particular instrument you hold in your balance sheet, can it be in the trading book as well as in the banking book? Can. Because if you look at treasury bond, let's take a portfolio of treasury bonds. So you have treasury bonds mature in 5 years' time, worth, let's say, 50 billion. Okay. So part of it could be in the trading book and part of it could be in the banking book. Let's say out of this 50 billion, 30 billion, worth of treasury bonds, you want to trade in the market. So what do? So consider that is part of your trading book. In the balance sheet, it represents as one element, but for the purpose of marketplace, you consider them as in the trading book. Then another 20 billion, you don't want to do anything, you don't want to buy and sell. So you just keep it for just to earn income until its maturity, where you get the maturity proceeds, you hold it in the banking book. So same instrument can be in both books, trading as well as banking. So when we talk about market risk, we only consider whatever the assets we hold in the trading book. Okay. Whatever liabilities we hold for trading book. Okay. And when you talk about equities, again, same. The same portfolio for stocks, part can be in the trading book, part can be in the banking book. Okay. So the part in the trading book is considered for market risk measurement. Okay. Then if you take foreign exchange and the commodities, we don't do a separation. Whatever the exposure in the foreign exchange position, we take into account, irrespective of whether we are doing trading or not. Commodities also same. So we don't do any separation when we want to measure the market risk. So that is the importance. What are the elements we take into account for the market risk? So remember two things: foreign exchange and commodities throughout the bank, interest rate and equities in the trading book. So today we start with the interest rate risk. So before we start, let's briefly look at key elements of interest and the interest rate. So if you look at the economic theory, so what is interest? It's the price of money over time and comprises. So basically every commodity has price. Okay. So here the commodity we are talking about is money. Okay. So money also has a price, which is called the interest rate. Okay. So basically, if you look at interest rate, there are four components which we consider when we assign interest rate. Now, one important elephant is because interest rate is directly related to the inflation. Okay, so it's a core element of inflation. So when you determine the interest rate, price of money, one factor you consider is the the inflation. Okay. Then cost of deferred consumption. So why, when you now, from a banker's perspective, what is meant by, why do you charge interest rate, particularly interest, for a particular loan? Because you are deferring the consumption ability of your bank. Okay. If I lend my money to the bank, so in other words, when I depositing my money, what I am doing? So basically, I defer my consumption and I am giving excess funds to you by deferring my consumption, for which I need a payment. So the bank gives me a rate, which is called the deposit interest rate. Okay. And the risk, again, possible risk of default. So where a bank determines based on the interest rate, the risk of the customer or the loan. So this is I want this much of percentage against my risk. So higher the risk, you have higher the interest rate. Okay. So basically, in determining interest rate, the key components: the inflation, cost of deferred consumption, and the risk. So the rate of interest is the scale of the price of money over time, usually quoted as a percentage per annum. Now, all of you know we express interest rate as a percentage per annum. When you say 2%, generally it implies 2% per annum. Okay, so that is the rate of interest or the price paid by a borrower of funds to a lender of funds. So when we talk about interest rate risk, a typical thing comes to our mind is the term structure of interest rates. So what do you mean by term structure of interest rates? So the variation in yield for related instruments that define maturity is known as the term structure of interest rate. As bankers, you know, whenever the maturity differs, now take example of your loans or even deposits. Okay, so do you charge same interest rate for loans with different maturities, or do you give the same interest rate for deposits with different maturities? No. So that depends on the market expectation. Market expectation. Okay. So on a given day, so given day means at a specific point in time, the relationship between the rate on short and long-term securities is represented by a graph. So how do we represent rate on vertical axis and the time on horizontal axis? Known as the yield curve. How many of you heard about yield curve? Or how many of you seen about yield curve? Anyone heard about yield curve? If you are working in the risk area, definitely you are very much interested about yield curve. So basically, yield curve shows the relationship between the interest rate payable on an instrument with different maturities for that given day. So this is at a time. So the yield curve may fluctuate every day, every moment. Okay. The yield curve which you build today is not the same thing which you find tomorrow, which you had yesterday. Because why? Market interest rate changes. The relationships observed between short and long-term securities will be different at different points in time. And they are forward-looking because yield curve helps the bank risk managers to look at future. So what would be the situation on my portfolio based on these forward-looking interest rates? Okay, these are forward-looking. So if you look at, I will just draw a small diagram. So here we have maturity and here we have interest rate. Okay, so let's say 1 year, 2 years, 3 years, 4 years. So there could be different. Can you all see this board? Can you all see this?
Not much clear.
Huh?
Not clear.
Not clear? Now clear? Is it clear?
That's better.
Okay. So here this is x-axis maturity, the y-axis interest rate. So here 1 year, 2 years, 3 years, 4 years. Okay. So let's say today, if you look at market today, so 1 year interest rate is, let's say 5%. So 1 year is 5%. 2 years, let's say 7%. 2 years, 7%. 3 years maturity, let's say you take a bond. Okay, you take a bond price today. So 1 year bond, the interest rate is 5%. 2 year bond is 7%. 3 year bond is, let's say 8%. And let's say 4 year bond is 10%. So just an example. So what do you see? So if you look at this trend, you see upward curve where whenever the maturity increases in this particular instrument, yield also has increased. Okay. So here I have drawn a relationship between maturity and the interest rate of a treasury bond. So this could be any instrument, even your deposits. 1-year deposit, 2-year deposit, 3-year deposit, 4-year deposits. Okay? So this is called the yield curve. This is very important, forward-looking. So how this will going to affect my portfolio, interest rate related portfolio in my bank. Now this is today. Let's say the time 0. Now tomorrow, what do you think? Tomorrow, what do you think? Will it be same or different? Will it be same or different? Come on. Will it be same or different? Can you all see this?
Yeah, it will be changing.
It will change. Now let's say
Yeah.
tomorrow. So now here the maturity, here the interest rate. Okay. Can you see now?
Yes, sir. We can see now.
All right.
Yeah,
Yeah,
fine,
alright.
fine. Sir.
Okay. So what we did was we built up a relationship between maturity. Now I am just taking one example of a treasury bond. Okay. So here what I am trying to do is, okay, today the interest rate okay, so then let's say 1-year treasury bond today, the interest rate is 4%. Okay. Can you see? Hello?
Yes, yes.
Okay. So 2-year treasury bond today, market interest rate is 5%. So let's say so on 6% for 3 years and 8% for 4 years. So the yield curve is something like this. So it is a relationship between the maturity and the interest rate. Okay. So here I took an example of an upward sloping yield curve. The yield curve is upward sloping, not necessarily. Generally, you see in a market like Sri Lanka, the yield curve is upward sloping, where the yield is higher for higher maturity instruments. Okay. Clear?
Yeah.
Okay. So let's say now we are at time 0, that is today. Now let's say we are in tomorrow. So when you go tomorrow, all these interest rates move up. Now here I took a parallel shift, similar interest margin, but not necessary. So tomorrow our yield curve is this. Okay, so this is t equals 0 position, this is t equal 1 position. Clear? So we tell that the yield curve moved upwards. So whenever yield curve moved upwards, what happens to our portfolio value and earnings will decline or go upwards. Okay. That is possible. So similarly, let's say tomorrow, this can also come down. Okay, this can come down. Okay. So the shape, now here for this example, I took upward sloping curve. But the yield curve, we will look at a little later, yield curve would be like this also. Okay. So this relationship is called the yield curve. So this is the yield curve of a treasury bond trading in a market. Okay. But now here I took a parallel shift. It should not be like this. Let's say today like this, tomorrow it could be like this. So this is not parallel. Why? There is a greater fluctuation in the short-term maturity bonds because there may be a demand for short-term bonds. Okay. So the long-term, there is no significant fluctuation. So the yield curve shift upwards or downwards may not by the same amount. Okay, clear? Any questions? Are there any questions? So in other words, this is the yield curve is very important element of a market risk or the specifically interest rate risk management framework. Okay, because this is a forward-looking thing, and when it goes ups and down, we know what is going to happen to my value of interest rate related instrument, or what is the impact to my income due to the fluctuation of interest rate. So yield curve is a typical component of a interest rate risk related framework. Are there any questions? Now let's look at and also we call this term structure of interest rate. We call this term structure of interest rate. Okay. So the yield curve shows the relationship between interest rate payable on an instrument with different maturities on a given day. Different maturities. So 1 year, 2 year, 3 year, 4 year. I mean up to 6 months, whatever. 30 years, 40 years. Now if you look at a treasury bond portfolio, maturities could go up to even 30 years. So it's a relationship between the maturities in the instrument. In some countries, some like government portfolios, the maturities extend to up to 60 years. So it's a significant long-ended portfolio. Okay. So this gives a message about how the market interest rate of different maturities of a particular instrument changes over time. Okay. So let's move on to the decomposition. Now, when you talk about interest rate, now when you say 8%, how this 8% build up of? How this 8% build up of? So what are the components? Let's move on to the presentation, getting used to the technology. So this is what this to me with technology. Okay. So anyway, so let's look at the term structure of interest rates, the compositions of yield curve. Now, if you look at the yield curve, okay, so there are 4 components. Ultimately, when you talk about 8% interest rate, there are 4 components. So what are the 4 components? The real rate, the expected inflation, the liquidity premium, and the risk premium. Okay. So what is real rate? Can anyone tell what is real rate? Now, what is real rate? Anyone? No? No ideas? I think in a market, you talk about what is real interest rate and what is nominal interest rate. Now, when you give a loan to a customer, what is that rate called? Would you lend at real interest rate or the nominal interest rate? What rate would you lend at?
At real.
Huh?
At real rate.
At real rate? Anyone else? Now, in an interest rate, when you talk about interest rate, there are 2 things: the real market interest rate and the nominal rate. So, what do you see in the market when you talk about interest rate? Lending rate, borrowing rate, deposit rate. What we are talking of? What is the interest rate we are talking of? I think you have to discuss. Others are on the lecture, others are doing something at home, cooking or cleaning or dancing or whatever you are doing, because I don't get any feedback. Except
exclude the inflation effect. When we exclude the inflation effect from the interest rate, that becomes the real interest rate.
No, what I asked was, now when you talk about now say your bank give a loan, 5-year loan at 15%. Okay, so what is the interest rate we talk? Is it the real rate or nominal interest rate? When you talk about that rate,
Talk about the real rate.
real rate.
Yes.
Anyone else? So if I go to your bank and your bank says me, okay, for 5 years, okay, my loan is at 14% per annum. So I have to pay 14% per annum. Is it the real rate or the nominal interest rate the bank is talking of?
Nominal
It's
interest
a nominal interest rate.
Nominal interest. So some says real interest rate, some says nominal. So we have to go for a vote now. Who will win? Okay. So when you talk about interest rate in a market, we talk about the, now when you talk about a loan, we talk about the nominal interest rate. Ultimate interest rate, the bank wants from the customer, depending on real rate, expected inflation, liquidity premium, and the risk premium. So basically, when you talk about interest rate for a loan deposit, we are talking about the nominal rate. The real rate is something in a risk-free world where enough liquidity is there and no inflation. That is the rate I want. There is no inflation in the economy. Now, when I am going to put my deposit in your bank, I ask some rate for me. I ask some price for it, which is called the interest rate on deposit. So when the bank say 1 year deposit, bank gives me 10%. I just don't want the real interest rate because I know there is a expected inflation over next 1 year. If the real interest rate is 10% and the bank also gives me 10%, I don't deposit money because there is no difference between putting my money in your bank or keeping it my home. When I deposit my money in your bank, I need some compensation for the inflation. So bank always offer me the real interest rate plus something for the inflation. Then again, when I put my deposit in your bank, I am losing my liquidity, which I could use it for some other purposes when I need it. But here I have given my money, so I lose liquidity. Then there is a liquidity premium I need. So I am now talking from depositor's point of view. Now, when I put my deposit for a 1 year, I go to commercial bank. I go to Bank of Ceylon. Okay, they say I will give my 1 year deposit 10%. But do I go to small finance company or smaller bank? Let's say Pan-Asia Bank, smaller bank, where I feel risk is high. So am I satisfied with the same 10% when I deposit my money in Bank of Ceylon and Pan-Asia Bank? No. The Bank of Ceylon says 10%. I will not put my money for 10% in Pan-Asia Bank or smaller finance company because I know there is a risk element. So I need an interest rate which covers all these 3 components on top of the real interest rate. Similarly, for your bank, when you grant a loan, first thing you look at is your real interest rate in the market real interest rate. So if there is no inflation, if there is no liquidity problem, now why in certain countries the interest rate is 0? Some countries interest rate is 0, some countries interest rate is negative. If I want to put my money in a bank, I have to pay something for them, but they don't need money. Enough liquidity. Enough liquidity. So simply because I can't keep money, I put money, they say, okay, I'll keep your money, give me a rate. Countries like Japan, so many years, interest rate is negative. They don't want money. They have enough money, enough liquidity. Money means here the liquidity. So when you ask for a particular rate from your customer, when you give a loan, again, real interest rate where expected inflation is 0, no liquidity problem, no risk, then you charge the nominal interest rate and real interest rate would be same, but it is not the case. In many economies, always you have inflation. It could be sometimes, positive or, sometimes we call deflation. It's the negative side. Okay, we are like Japan. So then when you tie up your money for so many years, then you need some premium for that. So that's why do you give the same loan at the same interest rate for 1 year and 5 years? No. Your 5-year rate be much higher than the 1-year rate, isn't it? Why? You are locking up your liquidity for different maturities. So 1-year rate maybe your loan rate may be 6%, but 5-year loan, your loan rate may be 8%. Why? Additional 2% for liquidity. So that is called the liquidity premium. Now take example of two customers coming, both 5 years. At your loan rate for Mr. A is 10%. For the same loan, same 10 million, 5 years, your rate is different. Why? The risk premium of the borrower. Okay. Because if a AAA rated customer comes to you, you will say, okay, I will only charge 2% risk premium top of my other factors. So your lending rate is 15% for 5 years. But BBB rated customer comes. So what is AAA and what is BBB? AAA is a very good customer, highly rated customer, high credit worthiness, less risk. BBB customer, high risk, less credit worthy. So you say, I need 16%. So you don't give the same loan amount, same term for the customer B at 15%. So they are the risk premium. So basically, those are the 4 elements, 3 elements on top of real interest rate, which determines the market interest rate. So when you tell 15%, that means within that 15%, you have real interest rate element, expected inflation, liquidity premium, and the risk premium. So that's how your bank decides the interest rate on your deposit or your lending. Okay, so we call when we if you take if you take 15% loan interest rate by your bank for 5 years, then you can decompose 15% into these 4 components. So in that 15%, the real rate may be 10%. So you have factored 1% for inflation. So 10 plus 1 is 11. Then you have factored another 2% for liquidity. Then 11 plus 12 is 13. Then another 2% for risk. 13 plus 2% is 15%. So you can decompose and see what are the typical components of my final interest rate. So we call decomposition of the yield curve. Any questions? Okay, so let's look at different now. The previous example, I only showed you a upward sloping yield curve, also called positively sloped yield curve. But a yield curve may be negatively sloped. We call downward sloping yield curve. Okay, or hump shape. You see in your handout, hump shape yield curve, or flat, like neutral flat yield curve. So there are typical 4 components. So I think you see in your handout there are 4 structures of yield curves. You see 4 structures of yield curves. The The first one is the upward yield curve, we call positively sloped. Okay. So what do you mean by positively sloped yield curve? I think which is the one which I explained earlier. So what do you mean by positively sloped yield curve? Where the market interest rate expected over the short to long term is showing an increasing trend. So basically, you have a short interest rate of short-term securities in the market, particular instrument, is lower than the long-term securities. Prominently, you see this particular pattern in many market instruments in many markets. Usually, you see the interest rate you charge or you get from investment in a longer end instrument is higher than the short end instrument. So this is a common thing. So this is something you see in a what do you call typical market. Now, second one is the negatively sloped. Okay, can you see negatively sloped? So now, what is this? What happened here? What do you see in this second graph? What do you see? Come on.
That's for a higher maturity, the lower the interest rates.
Higher the maturity,
Market
lower the interest
speculation
rate.
is going to be future interest rate. Yeah.
Sorry? I couldn't hear you. Sorry, what did you tell?
Yeah. For a higher maturity, the lower the interest rates, that means future market speculations is going down.
Okay. So will you see this in your banking? I mean, normal environment, have you seen this?
In Sri Lankan context, no.
But this is also possible because when you expect interest rate in the future may come down based on expectations and based now, if you look at this particular graph, what is the component which is more significant in deriving at interest rate in the second case? Which component has played a wide role? We looked at 4 components. Which component would you think played a wide role in the second graph?
Inflation.
Okay, partly. Okay. Okay, so forecasted inflation. Okay, but if you look at current inflation, because interest rate is fixed on the current inflation, expected inflation. Okay. Anything else?
Risk premium.
Most importantly, what would have been the factor?
Risk has been reduced. Risk has
Sorry?
been reduced. Risk has been reduced.
Why? If you look at a customer, say you are giving a loan to a particular customer, you say, if I am giving 1 year loan at this rate, 5 year loan at this rate. So customer is same. There is no reference.
So market liquidity position.
Sorry?
Market liquidity position.
Exactly. Because your market liquidity for the short term may be very tight. So you have a greater demand for short-term maturities where you don't have adequate funds. Where the market liquidity is during the next few years. So in this second graph, the liquidity component has played a wide role. the short-term rates are higher than long-term rates because there is a greater short-term liquidity in the liquidity problem in the market. So the liquidity is not enough for the short term. It's a greater demand, no supply, so you ask a higher premium. But over time, you expect there is no such pressure for the longer term funds. Remember, what is interest rate? The first slide, what is interest rate? What is interest rate?
Price of the money.
Price of money. So that price you for, like you buy coconut. Remember, when enough coconut supply, what happened? Price
Will decline.
decline. When less supply, price go up. Now here, in the short term period, there's a greater pressure on liquidity, so that your short term in may be higher than the long term. So this also is possible in a market. Usually we don't see. Okay. So this is called the negatively sloped curve. Then the third is hump. I have not seen, but it is possible. There's a possibility that curve may be like a hump. So there could be a possibility. It's not straight line, but hump. There may be upward sloping little bit, then again downward sloping after a particular period. It's not huge hump, but hump. Then the term to maturity and the flat yield curve. So basically, flat yield curve, irrespective of maturity, it's same interest rate. You may say in a particular period, which we difficult to explain, but it is possible. I mean, probably in certain periods where you don't have any liquidity problem, so this liquidity is not issue. No significant inflation, and generally risk of the fact whatever the factors appears to be the same, then the short or long your rates. Now some countries you see it doesn't matter whether you invest in a 10-year or 8-year bond or 1-year bond, they will offer you on the same interest rate. Okay, it doesn't matter because the market is very liquid, no expected inflation, and you don't see much risk in the economy or the borrowers. Okay, so this is also possible. Flat yield curve. So these are the 4 typical components of the risk, the interest rate structure. Okay. Any questions up to now? No? Okay. So let's move on to the next slide. Okay. So let's move to the slide. Can you see? Can you see the presentation?
Yes, sir.
Yes, sir.
Yes, it's okay.
So basically what I explained so far is what is interest rate and what is the yield curve. It's a relationship between the maturities and the interest rate for different maturity instruments, and the elements of the components of interest rate and the different structures of the yield curve. And now we will look at the interest rate risk. So what is interest rate risk? So the interest rate risk is the impact on value of assets and liabilities in the balance sheet, or impact on earnings of a financial institution or any other institution. I mean, it's common with a bank, financial, anything, which ultimately resulting impact on the capital due to fluctuations in the market interest rate. So as a result of movements in the market interest rate, means ups and downs of market interest rate, which result in loss of income, which result in loss of value of your assets and liabilities, ultimately affecting the capital, is called the interest rate risk. So there I have given the two components impact. On the earning side, you have impact on interest, net interest income, spread, ROA and ROE. So ultimately, as a result of movement of interest rates, the impact is on your earnings, basically interest income, net interest income, the spread, ROA and ROE. Then the next impact is on the value, the investment portfolio, loan portfolio, deposits, and ultimately the capital. So it's not very simple. So if you look at, because you don't have control on the market interest rate, as a result, when you hold a portfolio of interest rate related instruments, typically a bank, most of your instruments are the assets and liabilities are interest rate related, you are subject to significant risk. Okay. Now, so movement, next slide. So at any one time, financial institution hold both assets and liabilities. Movements either up or down will impact on profitability. If assets and liabilities are imbalanced, mismanaged, primarily because of a mismatch in the asset and liability maturity profile resulting from their intermediation function. So why this comes? Okay, so you have both assets as well as liabilities, which is related to interest rate. Then why interest rate risk arise? So if you have assets and liabilities, definitely, now take example. Now if the interest rate goes up, you will increase your loans interest rate. Similarly, you will increase your deposit interest rate. So you don't see a risk. If the interest rate comes down, you will do the same. You decline loan interest rate, you decline deposit interest rate. So there is no possibility of interest rate risk. Is it right? Is it the case? No.
Typically,
Yes, go ahead. Hello? Hello? Can you hear me? Hello?
the maturity of the interest
Yeah. I can't hear you properly. Something, I don't know, disturbance. But you are right, because
rates are not matching all the time.
So basically, the maturities are not matching. So the risk arises due to mismatch in maturities. Because if you look at your bank, assets tend to medium to long term. 2 years, 3 years, 5 years, 10 years, 15 years. But liabilities are short term. 3 months, 6 months, 1 year, 2 years. So you have a maturity mismatch. As a result, you will end up with the interest rate risk. So the key reason, because the financial intermediation, one component of financial intermediation is the maturity mismatch. Okay. So as interest rate volatility increases, the potential loss also increases. So if you live in a very volatile market where interest rate fluctuations are significant, your potential loss also significant. So that's the danger of interest rate risk when in a very volatile market. So when you talk about interest rate risk, there are two components related to the banking book. Remember when I explained the market risk, I said, what is we take as the market risk? 2 things in the trading book, 2 things in the banking, throughout the bank. So when you talk about interest rate risk, again, we can divide into 3 components, of which 2 are arising in the banking book. 1 is arising from the trading book. Impact is on the trading book. So the 2 which is arising in the banking book is refinance risk and the reinvestment risk. And the one which impact on the trading book is the market value. So the fluctuation in the market value. Okay. So let's look at the banking book risk, that is refinance risk and reinvestment risk. Okay, take this example. Now this is a different example to usual case. Now here we take an example of long funded position. What do you mean by long funded position? Maturity of liabilities greater than maturity of assets. Maturity of liabilities greater than maturity of assets. Now take an example I have given. Company mobilize a deposit, bank mobilize a deposit for 10 million for 2 years at 4% interest rate. Okay. So company mobilize 10 million at 4% for 2 years. And company use this 10 million to do a loan or grant a loan for 1 year at 6%. So company borrowed from a depositor by way of a deposit and 10 million at interest rate of 4%, which in turn the bank used for lending for 1 year at 6%. Now, what is the risk to the bank here? Is there any risk to the bank? What is the risk to the bank here? Is there any risk?
The repayment risk.
Repayment risk. What is the repayment risk? What is the repayment risk you are? Now here we are talking, I mean, of course, for this loan, there is a credit risk, but we are not talking about credit risk, but we are talking from the point of interest rate risk. So what is the risk here? Now we are talking from purely interest rate side. So what is the risk here?
Interest rate risk.
Yeah, what is it? I mean, I know, but
The interest rate may vary after some time. The deposit interest rate.
I am referring particular to this example. So if you could explain in this particular case, what is the risk now, given these numbers, things I have mentioned, in particular case, what is the risk?
Earning is not sufficient to pay the liability. That
Yes, we are earning
you have to
only
pay overall 8% for the 2 years. That means 4% and 4%. 2 years we have to pay. However, earning from loan is only 6%. That earning is not sufficient to pay the liability.
Earning is not sufficient. Okay.
We take the deposit for 2 years and lend for only 1 year.
Yeah.
The balance period is maybe idle. Balance 1 year.
But then again, you can give another loan. No?
Yes, it is not mentioned.
No.
Yeah, but sir, after 1 year, there may be a interest rate fall.
Exactly. So
due to that reason, reinvestment risk arise.
Yeah. So basically, yeah, you are right. Now, definitely bank will give another loan, no? Because bank 6% for 1 year. Okay. So now after 1 year, bank has to invest this 10 million again for 1 year, isn't it? Because bank has to earn an income. Okay. Because bank has 10 million. Okay. So yeah, borrowed for 2 years, loan given for 1 year. So after 1 year, when the bank receives the money from the customer or the borrower, then bank has to reinvest this loan again for 1 year, isn't it? Because after 2 years, bank has to ensure he pays 10%, 10 million plus 4% interest rate for 2 years. Okay. So the problem is if the market interest rate decline, he would not get 6% again for the next 1 year. So he has to reinvest 10 million loan for another 1 year to earn an income. But the question is whether he would get the same 6% for the next 1 year period. So if the interest rate declines,
it's like
sorry?
Say it's like current scenario. We generated fund at a rate of 12.5 for a leasing portfolio. Today we can't give a leasing at a rate of that rate. So due to that risk, reinvestment risk arise.
Yeah, reinvestment risk is when you have a longer term liability where your portfolio is short term, and when the interest rates are coming down, you have to invest in a lower rate, foregoing some of your income. So that is called the reinvestment risk. Now, if you take an example, this example again, let me go to the board again. Can you see the board?
Yes, we can see.
Huh?
We can see.
You can see the board, huh?
Yeah, that's better.
Okay. Okay.
Yeah.
So now in this particular example, so now your deposit is 2 years. 2 years. You took 10 million at 4%. Okay. So your interest cost is 10 million into 4% into 2 years. So how much your interest cost? Huh? 800,000. Correct? Correct?
Yeah, correct, sir.
Interest cost is 200,000. But when you obtain the 10 million, what did you do? You grant 10 million loan for 1 year at 6%. So 10 million into 6% into 1 year. Your income for the first year is 600,000. Okay. Let's say there is no change in the interest rate over the next 1 year period. Okay. So when he get this 10 million after 1 year, what he can do? What he can do? So he gets 10 million after 1 year. What he can do?
Can lend again.
Lend again. At what rate?
6%.
The same rate.
6%, because interest rate has not changed. So he will get another 600,000 for the next year. So his total income over the 2 year period is 1.2 million. Where his cost is how much? 800,000. Can you see?
Yes.
So his spread is, how much spread? 400,000, correct?
Yes.
So his spread is 400,000. Now, our risk, what is the risk? Unfortunately, the market interest rate falls. Market interest rate falls. Let's say instead of 6%, interest rate falls to 4%. Okay. Now what is his income for the second year is 400,000. His total income is now 1 million. 1 million. So my net interest income, the spread is now 200,000. So earlier, if the interest rate doesn't change, I would have ended up with taking a net interest income of how much? How much? 400,000. But now I ended up with only 200,000. So that is called the reinvestment risk. Whenever you have a long-ended liability with short-ended assets and market interest rate decline, result in a decline in income. Clear? Is it clear?
Very clear, sir.
Okay. So the other side of this is the refinancing risk. Now here we talked about reinvestment risk. So what is refinance risk? You have a long-term asset, the opposite of this, funded through short-term liability, opposite of this example, previous example. So you are borrowing short-term and invest for long-term. Invest means giving a loan or whatever. So your liability is short-term, your asset is long-term. So where the opposite of the previous example take place. So how the risk arises here? How the risk arises in this case? Take the example again. Take the example again. Now here, bank borrows from a customer or deposit for 1 year. 1 year, 10 million, and agree to pay 4% interest for 1 year. But bank lends that 1 million for customer for two years. Okay. So this is the deposit, this is the loan. So loan is for 2 years. 2 years at 6%. Okay. Now what is the scenario? So bank got a deposit, agreed to pay 4% for 1 year, but then this whole 10 million gave for 2 years. After 1 year, does he have money to pay the loan? Sorry, does he have money to pay the deposit? Huh?
No, sir.
Huh?
No, sir. They have to find it out from the market.
Yeah. So basically, because the loan is 2 years, so until 2 years, you don't get your 10 million back.
Yeah.
But the deposit is 1 year, you have to pay the deposit after 1 year. So he has to mobilize another deposit. So let's say he bought the market deposit rates, sorry, the interest rate won't change. The deposit rate remain as it 4%. So he now again go and obtain another 10 million deposit at 4%. So what is his total interest cost on deposit? 10 million
800,000
into 4% into 2 years. How much? 800,000.
800,000.
And
Yes, sir.
interest income on loan is 10 million into 6% for 2 years, 1.2 million. And his profit is 400,000. Okay. So if there is no interest rate change, this is the scenario. Because now let's say instead of 4%, interest rate rise to 6%. Now, after 1 year, when he want to raise 10 million in the market, he has to pay 6%. Now, what is his cost? His cost is first year 10 million into 4% plus second year 10 million into 6%. His cost is now 1 million. His income will remain same because there is no change. So now his net interest margin is only 200,000. So what happened? As a result of market interest rate went up, the bank's net interest income came down by 200,000. If you take a highly volatile market, over a 1 year period, many more things could happen in the interest rate. Let's take a very hypothetical example where interest rate went to 8%, almost double. It's a highly volatile environment. The market interest rate goes up. Both rates, lending and deposit rates, go parallelly by 8%. Now, what is the scenario? Second year, we have to pay 8%. So, my total deposit cost is now how much now? 1.2 million. But because interest rate went up, can I change my lending rate? I can't change because I had already blocked at 6%, unless it is a variable rate. So my spread will be 0. My spread will be 0. So I am at a significantly higher risk position. So that is the danger of the interest rate movements. So that's why it is very important for a bank to manage your portfolio maturities at a reasonable level. We will look at those in detail, but when you have a significant maturity mismatch, if there are significant interest rate fluctuation in a market, future interest rate fluctuations, you will end up with significant losses. So this is called the refinancing risk. So remember, two things we learned: reinvestment risk. So what is reinvestment risk? What is reinvestment risk? We discussed a few minutes ago. What is reinvestment risk?
Failure to reinvestment at a same or higher rate. Risk of failure to reinvest at same or higher rate.
Okay, failure to invest. The typical words. When you have a longer term liability,
right,
which has been used to invest in a short term assets, so always longer term liability, has been used to invest in a short-term assets, the declining interest rate resulting in potential loss of income, interest income. Okay. Refinancing risk is when you have a longer-term asset funded with a short-term liability. So longer-term asset funded with a short-term liability, potential increasing interest rate, resulting loss of interest income. So that is the refinancing risk. So you must clearly understand what is reinvestment risk, what is refinance risk, how it affects. So if you have a portfolio of assets and liabilities with similar maturities, we can minimize this interest rate risk to a substantial level. But of course, we look at all those things later on the day. Okay. Are there any questions? Are there any questions? Okay. So we'll move on to the next slide. Sources of interest rate risk. Now, when you talk about interest rate risk, there are 4 typical components we talk. Okay. What are the sources of interest rate risk? From where it is coming? The first one is called the repricing risk. So what is repricing risk? Okay. As financial intermediaries, banks encounter interest rate in several ways. The primary and most often discussed form of interest rate risk arising from timing differences in the maturity for fixed rate and repricing the floating rate of banks' assets and liabilities and off-balance sheet position. What do you mean by repricing? The repricing is when you set your interest rate at different times. When you have different timings on your assets and liabilities and off-balance sheet, they are not at the same time. As a result of change in interest rate, you are pricing with different timing. As a result of maturity mismatch, you are subject to repricing risk. Okay. So, for example, you have a 1-year fine FD obtained, 1-year FD obtained from a customer at 11%. You give a loan for 6 months to a customer at 13%. So you have a 1-year fixed deposit, 11%. You lend it for 6 months to another customer at 13%. So how does the reprice? Now these both are fixed rate. Asset and liability both are fixed rate. So how does the repricing take place? One, the asset repricing take place after 6 months. Liability repricing take place after 1 year. So there's a gap. In between, if the interest rate changes, what happens? There will be a risk. Because asset, you have to reprice after 6 months, but liability you can't reprice. Okay, so that is called the repricing risk. The risk arising from timing differences in the maturity. Okay. Or repricing of even variable rate at different times. So while such repricing mismatches are fundamental to the business of banking, they can expose a bank's income and underlying economic value to unanticipated fluctuations as interest rate vary. So this is a typical banking problem. I mean, if you are doing commercial banking business, this is the case. So you have to live with it. You can't stop it. But what is important is to identify your potential risk and maintain at a fairly comfortable level. Maintain it at a fairly comfortable level. Can't stop this, because naturally this timing difference will come in a banking business. For instance, a bank that funded a long-term fixed rate loan with a short-term deposit could face a decline in both the future income arising from the position and its underlying value if interest rate increase. So this is another example opposed to what I said. So when a short-term liability is used to fund a long-term asset, interest rate increase as a result of repricing, timing differences result in an impact on the or loss of income to the bank. These declines arise because the cash flows on the loan are fixed over time, while the interest rate paid on funding is variable and increases after short-term deposit maturities. Remember? So that is called the repricing risk. Then yield curve risk. The repricing mismatches can also expose a bank to changes in the slope and shape of the yield curve. The yield curve risk arises when unanticipated shifts of the yield curve have adverse effects on a bank's income or underlying economic value. For instance, underlying economic value of a long position in a 10-year government bonds hedged by a short position in 5-year government notes could decline sharply if yield curve steepens. Okay, even if the position is hedged against parallel movement. Now, yield curve risk means the movement in yield curve over a period for similar instrument may not be same. Remember, I told the yield curve may shift parallel, yield curve may shift not parallel. So even if you hedge a position, but the shift is not parallel, then again you are subject to interest rate risk, because the asset side risk may not be equal to the liability side risk. Okay, because of the differences in shift of the yield curve. Okay. So yield curve shift may be different. Can you see? Slide is not moving. Okay. Now basis risk. So we looked at two things. Repricing is yield curve risk, basis risk. What is basis risk? Another important source of interest rate risk, commonly reported basis, arises from imperfect correlation in the adjustment of the rates earned and paid on different instruments with otherwise similar repricing characteristics. When interest rates change, these differences can give rise to unexpected changes in the cash flows and earnings spread between assets and liabilities and off-balance sheet instruments of similar maturities or repricing frequencies. For example, a strategy for funding a 1-year loan that reprices monthly based on 1-month US Treasury bill rate with a 1-year deposit that reprices monthly based on 1-month LIBOR exposes the institution to the risk that the spread between the two index rates may change unexpectedly. What is that? Basis risk. So what is basis risk? Anybody understood basis risk? Can anybody explain basis risk? Can you see me? Can you see me of the board?
Yes.
Yeah. So what is basis risk? Can anyone explain basis risk, which I just mentioned? Now, you know repricing risk. You know yield curve risk. Now, basis risk is something like this. Now, let's say we have a loan, okay, for 1 year. 1 year. Loan rate is treasury bill plus 1%. Okay. So basically, you reprice every 1 year at this rate, treasury bill plus 1%. Now, you don't have any maturity mismatch. You give a deposit for 1 year. So you are matching your liability at asset 1 year with a liability of 1 year deposit. Your deposit rate is LIBOR minus 1%. Okay. So you are using different elements for asset and liability pricing. Different elements. So asset is priced based on the treasury bill rate. Liability is priced on the LIBOR rate. But your repricing is 1 year. So you don't have repricing risk here. Why? You are repricing during the same period. So asset also reprice 1 year, liability also reprice 1 year. But the here problem is the variable you use. Here the treasury bill, here the LIBOR. So the fluctuations in treasury bill over the 1 year period may not same as LIBOR. LIBOR may go like this, but treasury bills may go like this. So that is called the basis risk. The movement in even the interest rate goes and ups and down, how the treasury bill rate will vary is not exactly like LIBOR rate vary. So that is, even though you reprice, you have managed repricing risk, because you have 1 year repricing for both asset and liability, you are subject to basis risk. Clear? Okay. So let's move on to the note again. Okay. The final source is optionality. So what do you mean by optionality? An additional and increasingly important source of interest rate risk arises from the options embedded in many bank assets, liabilities, and OBS portfolios. So what are those embedded options? Formally, an option provides the holder the right but not the obligation to buy, sell, or in some manner alter the cash flow of an instrument or financial contract. Options may be standalone instruments, such as, we will discuss all those things when we come to later. So these options include various types of bonds and notes with call or put provisions, loans which give borrowers the right to repay balances, and various types of non-maturity deposit instruments which give depositors the right to withdraw funds at any time, often without any penalties. So if not adequately managed, the asymmetrical payoff characteristics of instrument with optionality features can pose significantly risk, particularly to those who sell them, since the options held both explicit and embedded are generally excised to the advantage of the holder and the disadvantage of the seller. Moreover, an increasing array of options can impose significant leverage, which can magnify the influences. So what do you mean by optionality risk? Anyone heard about optionality risk? What do you mean by optionality risk? Now, certain assets and liabilities in OBC carry an option, embedded option. Now, let's give an example. Now, you have a debenture. You have issued a debenture for 5 years, 5-year debenture. So you issue a debenture and raise money from borrowers, the investors. So you pay current interest rate of 5% per annum for each bondholder. So you are selling a bond for investors for 5 years at 5%. So what is this in your balance sheet? What is this? What is this in your balance sheet when you issue a bond or debenture? What is this?
Liability.
Huh?
A liability.
Liability. So you create a liability. Now is this an instrument subject to interest rate risk?
Yes.
Yes, because you are paying 5%. Now, if there is no option, what happens after 5 years? So you have issued 10 million worth of debentures. What will happen? After 5 years, you settle these debentures, but annually you paid 5%, okay, to the investors. But say when you sell this debenture, you create an embedded option to make this debenture marketable. What do you mean by embedded option? Can anyone, give an example of an embedded option? So embedded option is something like after 3 years, so option says when you originally issue this bond or the debenture to the market, the bank says any investor at the end of after 3 years can sell the bond back to the bank. Sell the bond back to the bank after 3 years at the market, whatever interest rate in the market, or bank, or even at the current rate. Okay. So what does it mean? So there's an embedded option given to the investor to sell it back to the issuer, the bank. Is there any problem with that? Is there any problem with that? Is there any problem with that? Or is there any risk with that? So if you don't have this, what is the situation? If you have this, what is it? Is there any difference? Is there any risk? Come on. Is there any risk?
It depends on the market interest.
Yeah, so what is the risk?
So,
what is the risk? I specifically I want to know. What is the risk?
We have invested for 5 years now.
Who has invested?
Company, a finance bank.
No, bank has not invested. Bank has sold this debenture. It's a liability. Bank has not invested. Bank has sold debentures for the investors for 5 years at 5%.
No, amount received has been invested for 5 years more than.
Okay. Oh, you have invested for? Okay. No, I am asking in particularly to this embedded option. Then you can link to whatever the investment you want to say. What is the risk? Because of this embedded option. First relate to that and then you can link to anything else. What is the risk?
Maturity mismanagement.
No, that is if you hold an asset with similar tenor, then the maturity mismatch, which we don't have that information. But I am asking particularly when you have this embedded option, what is the risk?
Liquidity.
We are talking about interest rate risk, not liquidity. What is the risk specifically? Because we are talking about four components, four sources of interest rate risk. Repricing risk, yield curve risk, basis risk, now final one, embedded option risk. Now let's say after 3 years, the investors get the right to sell it back to the bank, isn't it? So let's say I have invested 1 million in this particular bond, which I was earning 5%. I can hold it, let's say 3 years comes. So I am owner of this particular bond, 1 million. Okay, out of 10 million, I own 1 million. So after 3 years, I get a right to sell it back to the bank. Sell it back to the bank because of this embedded option. When I have that option, under what circumstances would I exercise it? The option gives you right to exercise. Okay? Because the option is something, the option holder, I am the option holder, has the right to exercise. I will only exercise that right if it is beneficial for me, isn't it? We will discuss all those things in detail when we talk about options. But for the time being, option is a right given to the holder of the right to exercise it if it is beneficial for me, the holder. Now here, this embedded option gives me the right to exercise as an investor. When I am going to exercise this?
If market rate is increases, seller
market rate is
increases.
Increases, right? Why? Now I am earning 5% on this bond. Let's say market interest rate goes to 7% in the market. So after 3 years, let's say now after 3 years have come, market interest rate 7%. I have option. Why should I invest my money in a bond giving only 5%? When I have opportunity into 7%. So since I have this, if I didn't have this option, I can't do anything. I have to wait for 5 years to get my money back. Now, after 3 years, market rates gone up. What I'll do? I will exercise my option. If there are alternative investment, I can invest. Okay? I can invest. So if I sell it back, and if the bank doesn't find any opportunities in the market to get the same return, then bank is at a loss. It could be otherwise also. Let's say I need money after 3 years. Not necessarily market interest rate goes up. I need some money. So when I need money, I will sell it. I will sell my bond back to the bank. It could be anything. I may sell it because the market interest rate goes up, but not necessarily. Suddenly I need my money as an individual. So I have this option now. After 3 years, I will sell it back. Unfortunately, let's say the opposite. At the time of selling, interest rates have also come down. The investment opportunities have come down. So when I sell, the bank has to invest at a lower rate because the market rate has come down. So it could be any reason, okay, which makes the bank at a disadvantage. It makes the bank at a disadvantage when an embedded option is there. Okay. It could be on the liability side, it could be on the asset side. Okay. So that is called the optionality risk. So the four sources: repricing risk, yield curve risk, basis risk, optionality risk. Clear? Okay. So we'll stop at that point for a small tea break. So we are almost 10:45 here. So we will start the session again in 30 minutes time at 11:50. So if you have any questions, get ready with those questions when we start the session at 11:50. Okay? Shall we start after the break? Are there any questions before we move on to the next area? Are there any questions or clarifications? Okay. So if not, we will move on to the next area. So basically now we know what is interest rate risk, what are the different sources of risk, and now we move on to the area where how we can measure the interest rate risk. Now in your bank, what are the techniques that we can use to measure the interest rate risk? Because once you identify the risk, we have to measure the risk and then we have to treat the risk. So first we look at different models. There are many models, but 3 basic models where you can use, and some of your banks may be using these models already, or at least few models to measure the interest rate risk. So during this program, we will look at 3 models: Cumulative Gap Model, also commonly known as Repricing Model, then Maturity Gap Model, Duration Gap Model, and the Convexity. Okay. So we'll start with the Cumulative Gap or Repricing Model. So how this model works? Now in this model, we basically use book value of assets and liabilities. So we are not looking at market values. So we simply take book value of assets and liabilities based on rate sensitivities. So what do you mean by rate sensitivity? Means the assets and liabilities which are sensitive to interest rate or subject to repricing during a particular time bucket. Okay. So basically the rate sensitive assets we call RSA, rate sensitive assets, and we call rate sensitive liabilities RSL. Okay, the rate sensitive means any asset subject to changes in interest rate or subject to repricing within a given time bucket is called a rate sensitive asset or liability. So what we do is we divide balance sheet assets into 2 components: rate sensitive assets and rate non-sensitive assets. Similarly, we divide the balance sheet liabilities into 2 components: rate sensitive liabilities, rate non-sensitive liabilities. So that's how we do. So then once we identify rate sensitive assets in the balance sheet and the rate sensitive liabilities in the balance sheet, we take the difference, that is RSA minus RSL, and see, so we call the repricing gap. So RSA minus RSL is called the repricing gap. Okay. Then if the RSA is greater than RSL, then we call a positive gap. If the RSA is less than the RSL, we call the negative gap. Okay. So when you do this, or when you compute the repricing gap, so what is repricing gap? Difference between the RSA minus RSL. So it could be positive, it could be negative. So you may end up with a positive gap or negative gap. So once you arrive at that number, you can estimate the impact on your net interest income due to increases or decreases in interest rate. Okay. So you can simply compute the impact of net interest income as a result of increase or decreasing interest rate. And we can use this formula, very simple formula, the change in net interest income, equal, now here I have put for different gap buckets, that's why I, equal gap in a particular bucket multiplied by the change in interest rate. So in other words, RSA minus RSL, the value of rate sensitive assets in the balance sheet, minus value of rate sensitive liabilities in the balance sheet, multiplied by change in interest rate. Change in interest rate, delta R, that is the up or down, is the impact on your net interest income. So the change in net interest income. So this is the typical measurement we used in many banks. We call repricing gap model to measure the quantum of interest rate sensitivity, quantum of impact your net interest income as a result of increase or decreasing interest rate. So when you compute the gap, you can model it for different interest rate scenarios. Okay? You can model it. Now in this particular table, I have given 4 scenarios. What are the 4 scenarios? First scenario is, I will take, there are, all of you can see, there are 2 scenarios with green light and 2 scenarios with red light, red color. So if you look at the green color scenarios, you see the first one and the last one. First one, what does it mean? The gap is negative. So what do you mean by gap is negative? You have more rate sensitive liabilities than assets. And change delta R is negative. What do you mean by delta R negative? What do you mean by delta R negative? Anyone? What do you mean by delta R negative? No thoughts? Or you are not doing something else?
Interest rate decreases.
Huh?
Interest rate decreases.
I can't hear.
Interest rate decreasing trend?
Yeah, the interest rate has decreased. Okay, or expectation is interest rate to decrease. So delta R negative means change is negative, means declining interest rate. So if we have a negative gap and interest rate expected to decline, the impact is of course positive for you. impact is positive for you. That's the important factor. So you should not worry about a environment where you have a negative gap and potential risk is the declining interest rate. So you ended up with, in fact, increasing net interest income. So you are not worried. Then I'll go to the last one. The gap is positive and the delta R positive means increasing interest rate. So if you have a positive gap and expectation also increase interest rate to rise in the market, again you end up with a positive net interest income. So that means your interest rate income change will be positive. So in the first and fourth case, as a banker, you may not worry too much. But let's take the second and third one. The second one, the red color, your gap is negative. That means your rate sensitive liabilities are more than rate sensitive assets. In such a case, if there is a positive delta R, that means the interest rate rise, you end up with declining net interest income. So the change is negative. In the third line, you have a positive gap. Your rate sensitive assets more than rate sensitive liabilities, but interest rate decline from the current position. Then delta R is negative, you end up with a negative change. That means you will your net interest income will decline. So the second and third scenarios are the most important ones for a banker to see or to quantify the impact of its net interest income. So whenever you have a negative gap and there's a possibility of increasing interest rate, you have to be very careful. Or when you have a positive gap and you expect interest rate to decline, then you have to be very careful. Okay. So this is the job of risk manager. Any risk manager who is looking at the interest rate risk using repricing model. So what you have to do is to manage your gaps at a reasonably comfortable level. Reasonably comfortable level. Any questions? Any questions? Okay, let's work out a small example. Now consider the following balance sheet. Okay, consider the following balance sheet. Now you have a very simple, very basic balance sheet for the just for the explanation. Now you have rates. Now here it is divided into rate sensitive assets as well as rate sensitive liabilities. On your balance sheet, you have rate sensitive assets worth 500 million, giving a return of 8%, the current return of 8%. And similarly, you have a rate sensitive liabilities of 600 million, giving a rate of 4%. Then on the asset side, you have fixed rate loans or whatever worth 350 million, giving a return of 11%. Similarly, fixed rate liabilities giving 220 million at a cost of 6%. Then other non-earning assets 150 million and other liabilities 100 million. Then equity 80 million. So total assets and liabilities and equity matches as 1,000 million. So now, if you compute the current net interest income, how much the current net interest income for the bank based on these numbers. On 500 million, you will earn 8% return. So 500 into 8%. Plus, on 350 million, you earn 11%. So we don't earn anything on non-earning assets. Then your interest cost to the on liabilities is you pay 4% on your 600 million rate sensitive liabilities times you pay 6% on your fixed rate liability. So 6% on fixed rate liabilities. So 0.06 into 220. So the difference between these two is your net interest income, which is 41.3 million. If you consider net interest margin is 41.3 divided by earning assets 500 plus 350, 850, 4.86. Now this is typically how you work out the net impact on net interest income if you don't have any other thing. But previous slide we learned we can use the gap model to estimate the same without doing all these things. So can you use gap models to estimate the impact on net interest income? Repricing gap model. Take a couple of minutes, use the gap model to compute the repricing gap. Or before that, okay, before that, let's do this. Okay, now this is based on the current interest rate. Now let's take an example of the impact to the bank if the interest rate goes up by 1%. Can you work out the net interest income the same way if the market interest rate goes up by 1% parallelly on all interest rate related instruments? Parallel shift. Okay? Clear? So work out, now we already work out based on the current interest rates for the both assets and liabilities, the net interest income. Now, if the if the interest rate goes up by 1% parallelly for all instruments, both assets and liabilities, can you estimate the new net interest income? Take about 2 to 3 minutes, work out 10, see what the answer you get. Okay, we have about 2 to 3 minutes. So everybody please work out the similar way. If the interest rate increased by 1%, your net interest income. Okay, take about 2 to 3 minutes. Can you work out? Once you finish, please, of course, you can't raise your hand, but just speak and tell the value you got.
Is it 40.3?
Huh?
40.3?
40.3. Okay. Anyone else got the number? What about others? Someone came with 40.3.
Same answer, 40.3.
40. Everybody got 40.3. Anyone find it difficult? Please tell, because don't just keep quiet if you find it difficult or if you don't understand. Please ensure that you clear all those things, because once we pass this point, we don't discuss it again unless there is a question of similar nature in the exam. Everybody is there? Anybody who don't understand, how did you get? Still working? You need some more time? Everybody got clear or not clear? Please tell whether you got the answer. A couple of you guys got the answer, but what about others? I can't see any one or few. Or find it difficult to get it. Okay. Since I don't get any response, I'll proceed. Okay. So let's look at the structure now. Now earlier, our rate sensitive assets gave a yield of how much? 8%. Now when the interest rate goes up, the yield goes to 9%, because I said 1% increase. Then fixed rate earlier gave 11%. Now the interest rate goes up by 1%. How much the fixed rate loans would be? Huh? How much?
It is same.
It remains same because it's already fixed. Those are not rate sensitive, or those are not repriced during the 1 year period. Let's say we are talking 1 year period. So the rate remains same because we have already fixed at 11. So rate won't change. So when we go to the liability side, there are rate sensitive liabilities which costed 4%. If the interest rate goes up by 1%, the rates would go up by 1% to 5%. Then there are other liabilities which costed 6%, and rate will remain same because those are not rate sensitive. Because in the example, it is clearly identified what is rate sensitive and rate non-sensitive. So now again we rework our net interest income. That is the interest income minus interest expenditure. So the interest income is 500 million into 9% plus 11% into 350 million. Interest expenditure is 5% into 600 million plus 6% into 220 million. the net interest income is 83.5 minus 43.2, 40.3. And net interest margin is 40.3 divided by 850, 4.74. So basically what you saw, what has happened as a result of 1% increasing short-term rates. So this is the possibility. So what do you see? What has happened? Or what could happen if the interest rate goes up by 1% for this particular bank? What is the scenario? What is the scenario? What happened? I mean, we know the previous net interest income. If there is a 1% increase in short-term rates, we know the scenario. So what is the result? Come on. What is the outcome? What is the result of increasing interest rate?
Net interest income and the net interest margin decreases.
Net interest income and the net interest margin has declined. Okay, that is obvious. We have seen that. So earlier net interest income 41.3. Now it has come down to 40.3. So there's a drop of 1 million rupees. Net interest margin earlier 4.86. Now it has come down to 4.7. Why this happened? Okay. What is the reason? So can you link this to the previous theory we discussed? Why this happened? If you go back to your previous notes, this is the scenario that should happen. Why? What is the scenario? What is the reason? What is the reason? You see, please tell, what is the reason?
The gap between the assets and liabilities are negative, and the interest rate is increasing. Therefore, we end up with a negative result.
Okay, exactly. I hope others are also with us. So they are sleeping or I don't know, cooking or whatever, scraping coconut or whatever, but at least couple of you with us, you see the gap is negative. So what is gap? Rate sensitive assets minus rate sensitive liabilities. So we have 500 million rate sensitive assets, 600 million rate sensitive liabilities. So you have a negative gap. So when you have a negative gap and if the interest rate goes up, what is the end result is a negative impact. The net interest income would decline. So that is the theory, which you see in practice in this example. So with a negative gap, you have more liabilities, rate sensitive liabilities than the assets. So the net interest income fall and net interest margin will fall. So now can you use now all this we worked out manually, but can we straight away use the gap model to come up with the answer? Gap model, which we discussed. The gap model. So can you use the gap model to arrive at the same answer? Take about 2 minutes, use the gap model, repricing gap model to arrive at the impact. Now we worked out separately for each asset and liability here, but use the gap model. Anyone use the gap model to come up with the answer? Anyone done? Finish? Okay. So if you don't work out, so what is gap model we looked at? So change in net interest income, I think all of you can see, equal repricing gap, that is RSA minus RSL, multiplied by change in interest rate. So what is RSA? 500 million, RSL 600 million here, times we are talking about how much change? 1% increase. So the change is positive, 1% positive. So negative 100 million times 1% means 0.01. Okay, that is negative 1 million. So what does it mean? Our net interest income will decline by 1 million. So for this particular bank, if there is an increase in interest rate by 1%, income will decline by 1 million from the present position. So this is how we use the gap model to estimate the impact on net interest income. Clear? Take another example. So you have rate sensitive assets of 1,000 million, rate sensitive liabilities of 800 million, and interest rate moves from 8% to 6%. So take example, in your balance sheet, you have rate sensitive assets of 1,000 million, rate sensitive liabilities of 800 million. The interest rate moves from present 8% to 6%. So basically interest rate declined by 8% to 6% over a 1 year period, next 1 year period. So what is the impact on net interest income? Please work out quickly. So what is the impact on your net interest income? So RSA 1,000, RSL 800, present interest rate 8%. Over the next 1 year period, we expect interest rate to come down to 6%. So what is the possible impact of this has on your net interest income?
4 million reduction.
Huh?
4 million reduction.
4 million reduction. 4 million reduction. Anyone else? Any other answers?
It's 4 million.
I'm asking the impact. 4 million what? Increase or decrease? Increase or decrease 4 million?
Decrease.
Decrease, okay. So how do you get? So our impact is RSL, RSA minus RSL here, 1000 minus 800 times change in interest rate. Now here the change is negative 2%. Negative 2%. So minus 200, sorry, plus 200 into 0.02 negative. Okay. So it's negative 4 million. So if your bank's position is this, if the interest rate decline by 2%, you have a negative impact on your net interest rate. So this is very important. Clear? Any problem? Any question? Okay. Okay. So let's move on to another example, repricing gap. Now here I have put, now when you talk about repricing gap, we can subdivide it into the period, maturity period, we want to look at the impact. So if we want to look at the impact over next 1 day, we can talk about the repricing gap of assets and liabilities for 1 day. For example, 1 day your balance sheet repricing assets 20 million and repricing liabilities 30 million, your repricing gap is 10 million negative. And the very last column is the cumulative gap. The cumulative gap is gap today plus gap for the next period. Okay. So then we move on to the gap between 1 day to 3 months. Okay, now we compute the gap for the next day, the next day to next 3 months from today. So you have rate sensitive assets 30 million, liabilities 40 million. Again, you have a negative gap of 10 million. Now, what is the cumulative gap? The previous 10 plus current 10 negative 20. So cumulative gap is 20. So what does it mean? If you look at from today up to 3 months time, my repricing gap is negative 20. Of which 10 is arrived from the first day, the balance 10 arrived from the first day to 3 months. Then if I move on further, if I want to look at the gap for the period 3 months to 6 months, from 3 months to the next 6 months, my gap during that period is 70 minus 85 minus 15. But if I look at the gap from today up to 6 months, my total cumulative gap is negative 35 million. That is minus 20 plus minus 15. So similarly, my gap from today to 1 year is minus 15. My gap from today to 5 years is minus 5. But at the end, my overall gap over 5 years is 0. Okay. So this is another way of looking at the gap. Now, if you take that example, again, if I want to measure the gap of this example, net interest income, the impact of net interest income with 100 basis point increase, that is 1% increase. What is the impact? My gap is how much? Negative 15 over the next 1 year period times increase of 1%, 100 basis point means 1%, is multiplied by 0.01. So my impact on net interest income is negative 150,000. So if I have a position like this in my bank, over a 1 year period, if the interest rate goes up by 1% or 100 basis point, I will lose my income or the the interest income up to 150,000. Okay. So this approach is pretty simple approach. I mean, you don't have to worry much about these numbers. Where most of Sri Lankan banks use this model. How many of your banks use repricing gap models? Anyone, if you work in this area or if you know whether you work or not, how many of your banks use repricing gap as a risk interest rate measurement tool? How many of your banks use? Anyone? No? Probably using, but you may not aware or you have not heard, but most of banks use repricing gap model to measure the possible interest rate risk. Okay. So let's move on to the another parameter which you can use as a risk tool for the level of risk using the same model, which is called the C gap ratio or the cumulative gap ratio. So if you want to look at the level of, or if you want to quantify the level of risk, another important ratio you can use the C gap ratio, which is equivalent to the cumulative gap over a particular period divided by the total assets. So if you can maintain that at a comfortable level, always you are safe and you can manage the interest rate risk comfortably. Sometimes your bank can have a benchmark stating this is my targeted C gap. So what does it mean? If my C gap is going to go above it, I have to be very careful to take appropriate measures to bring it down to the level which I need to maintain. So that depends on the each bank's policy. Each bank may not have the same C gap. How vulnerable, what safety measures you have will decide what is the right target C gap ratio. For example, the bank A may think if we can maintain our C gap ratio at around 10%, we are comfortable. We can manage our interest rate risk. But another bank may have a C gap ratio of 15%, where they feel we can allow gaps to increase up to 15% so that still we can manage our interest rate risk. So it's the decision of the bank, individual bank, to set up a C gap ratio based on the risk tolerance level or risk appetite and other many other factors, internal factors, where the company feels, the bank feels you have in place. So this again another tool we have in place to measure the risk level as a result of gap. Okay. Now let's work out another example before we wind up for the day. So I have given some assets and liabilities. So think about, we are talking about a 1 year period. So our horizon is 1 year repricing. So if our horizon is 1 year repricing, think about what are rate sensitive assets, what could be the rate sensitive liabilities, and how much impact this particular bank would have if interest rate goes up by 1%. Okay, can you quickly work out? Assuming the knowledge you gathered, what is rate sensitive assets and what is rate sensitive liabilities. So we have about 13 minutes remaining for the session. So take about 3 to 4 minutes to work out the impact of net interest income. Anyone worked out the numbers? Anyone come up with the numbers?
Assets 140 million, liabilities 150 million, gap is 10 million.
Asset 140, liabilities 150. Is that what you said? Asset 140, liabilities 150.
Assets 140,
Yeah.
liabilities 150, then the gap is 10 million.
Yeah. Always when you tell about gap, tell with the positive or negative one.
It's a negative gap. Liabilities are more than assets.
Okay. Anyone else? Okay, by the way, how did you get 140? How did you get 140 and 150? How did you get 140 and 150?
There's a small correction. Asset should be 115 because I have added longer term consumer durable loans also. Here the assets can consider only short term consumer loans 50 million.
Okay.
3 months treasury bill 30 million and
Yes.
6 month treasury bill 35 million. Others are more than 1 year. In liability side, savings 30 million, 3 months CD 40 million, 3 months TD 20 million, and 6 months CP 60 million.
Okay. Any other ideas, thoughts, answers? So we will keep it also. Any other numbers anyone else have worked out? Or is the same? Anybody else? By the way, what's your name? Any other numbers? Anybody else worked out? No? So no one has worked out yet?
Gap is minus 75.
Sorry?
Gap is minus 75.
Minus 75. Okay. So you have different rate RSA and RSL. Anyone else? Some more answers? Are there some more answers? No? Okay, let's look at it. Now, here we want to look at cumulative gap for 1 year. So basically, we have to look at either rate sensitive assets or rate sensitive liabilities, or assets and liabilities subject to repricing during a 1 year period. Okay. So with that thing in mind, so let's look at the rate sensitive assets in this balance sheet. Now, short-term consumer loans definitely below 1 year. So those will be definitely repriced, has to be repriced within a year period. So we can take short-term loans as RSA, 50 million. Now, long-term consumer loans generally over 1 year, so those will not be subject to repricing during a 1 year period. 3 months treasury bill. So treasury bill mature in 3 months, definitely you have to reprice after 3 months. 6 months treasury bills, again below 1 year, we have to reprice after 6 months. 3-year treasury bonds. Now 3-year treasury bonds, you get a coupon, but coupon will not be repriced because that's a fixed rate So you don't have to reprice within a 1 year period. 10-year fixed rate mortgage, anyway, it's a fixed rate mortgage, 10 years, so you don't have to reprice. 30 years floating rate mortgage. So what is a floating rate mortgage? Annually or semi-annually, you have to reprice. So even the mortgage is 30 years, the interest rate is repriced either 6 months or annually. Okay, so that means even that includes as a rate sensitive asset, because the price will change every 6 months or 1 year, because that's a FRM, means floating rate mortgage. Probably some of you didn't know about it, so that is the reason. So floating rate mortgages, annual or semi-annual, so subject to repricing. So here what we have is 50 million short-term loans, 3 months treasury bills, 6 months treasury bills, and 30 years floating rate mortgages. 50 plus 30 plus 35 plus 40, 155 million worth of rate sensitive assets. On the liability side, generally, anyway, demand deposits and savings deposits we don't consider as a, because if you look at anyway demand deposits, we don't have any interest, but even savings deposits are not subject to frequent repricing in a bank at very short intervals. So savings generally we assume as not repriced over a short tenure. So then we have 3 months CDs, we have to reissue at the new rate. 3 months term deposit, we have to reissue at the new rate. 6 months commercial papers, we have to reprice at the new rate. 1 year TD, we have to reprice after 1 year. So then we have 40, 30, 60 plus 20, 140 million worth rate sensitive liabilities. So our repricing gap is 150 minus 140, 15 million. So if there is a 1% increasing interest rate, what happens? Our gap is positive. The change in interest rate also positive. You will end up with a positive net interest income of 150,000. Of course, if the interest rate goes down by 1%, you end up with negative net interest income of 100. Negative change in interest income of 150,000. Basically, net interest income will decline by 150,000. And C-gap ratio would be 50 over a 1 year. 1 year C-gap ratio is 15 million divided by total assets 270 million, 5.6%. Depending on your target C-gap ratio, you can see whether your risk level is high or low. So then you can use this as a tool to adjust your portfolio to the manageable level, depend on your target C-gap ratio. I think you understood and it's clear, or any questions of it? So we stop at that point. So before we stop, wind up the class, are there any queries with respect to C-gap?
So C-gap ratio, when it is high, what is the average percentage?
That depends on your bank's policy. So let's say the C-gap ratio is something you have to decide in your own, which you can manage, which you think you can manage. Now, let's say you are from Bank A. So your risk managers think my target C-gap ratio is 10%. Okay. So if I see, I have a significant negative impact, I can tolerate up to a 10% level. Okay. Let's say when you forecast your C-gap ratio for a possible interest rate change for a 1 year period or whatever period you think, let's say 1 year period, so your target gap is 10%, you feel your gap ratio would end up with 14%. Then you see there is a risk, greater risk, because you can maintain up to a C gap of 10%. That's why you set a target of 10%. But when you do this calculation, you feel over next 1 year period, if the interest rate goes up or down, your C gap will be adversely affected over 10%. Let's say 14%, then it is an indication you have to immediately adjust. So you don't have control over interest rate. You can't adjust interest rate, market interest rate immediately. So you have to readjust your assets and liabilities to manage it within the level it is comfortable. I can't say there is a standard benchmark saying, okay, this is the ideal C gap for a bank. It should be very short number, very low number. But the internal bank management should decide based on your resources and capacity to, meet any risk as a result of adverse negative C gap. So it's up to your bank. It may vary among banks, but what is important is monitor the C gap regularly to ensure the expected C gap would be maintained within the targeted C gap. Any other clarifications?
So can you please explain why we did not consider saving and term deposit as short term?
So we consider term deposits.
We consider, no? Saving.
We considered, but 2 year term deposit we didn't consider because now we are looking at 1 year gap. Except 2 year time deposit, we consider 3 months CDs, we consider 3 months TDs, we consider 6 months CP, we considered 1 year TD. Okay, except savings, because now if you look at short tenor, the repricing, I mean, due to the fluctuations in the market interest rate, you don't see you change your savings rate at short intervals. But of course, savings rate are more, changes take place at more long intervals. Okay? Because if you look at every day, the interest rate could change, but you are not going to change your savings rate more frequently. It's a more longer term decisions. I mean, when the interest rate changes significant amount, you ultimately change the interest rate for savings deposits. You don't do frequent changes. So generally we ignore that as a rate because it's highly fluctuating. There is no problem in it, but usually repricing won't take place at short intervals in the case of savings deposit. Maybe in your banks, I mean, I don't think you change every day, every month, whatever the, every 3 months, are you changing your savings rate?
No, okay, thanks, got it.
Okay. Any other questions before we wind up? Okay, if we don't have anything, so we will move on to the rest of little bit on C gap theory, and then we will move on to the other models next week. And we will work out some questions as well.
Excuse me, sir.
Yeah.
So the previous recordings have not been posted on IBSL portal.
Sorry?
The previous recordings, the previous visual recordings have not been posted on IBSL portal. Is there any particular reason to that? I
think it is there, I think.
The recordings,
I can check with them, but I think it is there. They even send me a copy, link.
I have the link. Right. Let me check again.
If you call IBSL Maneco, someone in the IBSL who is coordinating the program, probably they will tell you. I think it is there.
Because I'm an overseas student, I have sent email as well. I will check again with him.
So why don't you check with the IBSL, the coordinating officer, whoever for this particular course,
Right.
But whoever officer, definitely I think they can help you if you don't get it.
Okay.
I think they provided me a link also.
All right. Okay. Thank you.
Please contact them. I will also tell them.
Okay.
But please contact them if you have any problems.
Okay. Thank you.
Okay. Welcome. Okay. So we'll stop for the day. So we'll meet again on next Sunday with the balance part of the interest rate. But remember, yeah.
Sir, small question regarding the savings, considering savings as RSA, because due to this COVID-19, we are like frequently changing the interest rates also relating to savings. So in that case, can we consider?
It's very seriously over a number of times. I mean, I don't see any problem in taking, but generally, I mean, you don't set. Here repricing. We are referring to repricing, but generally the savings we don't reprice more regularly. So that's why I mean, if you really feel you change your interest rate, there is no harm in taking it.
Okay, so thank you.
There is no hard rule saying, but generally because savings are not subject to reprice. I mean, any bank, if you look at savings, the rate remain because savings anyway they are paying a pretty low rate. So unless there is significant change in the market rates, you change. Okay.
Yes.
So then you can take, no problem.
Okay, sir.
So there is
Thank
no
you.
hard rule. Please remember, hard rule saying you should not take. But generally, we know. I mean, if you feel you are saying there's a significant interest rate fluctuation, which could lead to the repricing of savings, of course, you should take it. So there is no harm in it.
Okay.
Okay. So that.
Thank you, sir.
Yeah. Okay. Any other questions? Okay. So if you don't have any more questions, so anyway, you can, if you have any questions, you can discuss next time. If you have any more questions, please be ready with your calculators because sometimes you need to work out. So it's better you have your calculators also with you when we want to work out any questions from here onwards. So always, if you have any questions during the session, please stop me and ask because we don't get opportunity to discuss them again and again once we finish the relevant sections as we go. Okay, thank you.